China, the economic powerhouse that fueled insane growth for decades. But lately, something's off. Stocks are tanking faster than you can say market correction. Headlines are screaming about tech giants getting hammered by the government. And even the local hedge funds, the ones supposed to know how to navigate the situation, are bleeding cash. So the question is this just a bump in the road, or is China's crazy growth story about to flatline? But wait, hold on, there's more. Big US hedge funds, the Wall Street sharks, are apparently swooping in and buying Chinese stocks like it's Black Friday. So what the heck is going on? Are they just covering shorts, or could there be a hidden opportunity here? Plus, the Chinese government isn't standing still, they're buying up stocks left and right trying to stop the bleeding. But let's talk about the elephant in the room. China's economy is slowing down. Those sweet GDP numbers aren't what they used to be. You may think, but it is still around 5%. And yes, you're right, but in a country where GDP is driven by government spending on construction projects, it is the real barrier of real growth or decline. Manufacturing sector is stagnant, so what's Beijing doing to fix it? They're slashing interest rates and couple other changes, some more risky to try to get the money flowing again. But there's a million yuan question. Is it too late? Is all hope lost? Are we witnessing a long, painful slowdown or just some short-term drama? And hey, amidst all this chaos, are there any hidden gems on the Chinese stock market? Well guys, that's what we're about to find out. Buckle up, because this is the story of China's economic roller coaster and whether it's about to fly off the rails or make an epic comeback. So let's start with Chinese turbulent stock market landscape. The world's eyes are on China's stock market, a whirlwind of declining prices and mounting uncertainty. The once booming tech sector, a symbol of Chinese economic prowess, has been shaken to its core. In recent years, the Chinese government launched a sweeping regulatory crackdown on its tech giants. This campaign, aimed at curbing monopolistic practices and data privacy concerns, sent shockwaves through the markets. Giants like Alibaba and Tencent, once darlings of investors, have seen their valuations plummet. Trillions of dollars in market value have vanished, as seen in the staggering 1.1 trillion loss highlighted by Reuters in July last year. The consequences ripple beyond China itself, with Chinese hedge funds struggling to reassure investors amidst significant losses. The international financial media paints a bleak picture. Analysts, like those at Morningstar, urge investors to steer clear of Chinese stocks altogether. Calls to avoid buying the dip, echoed by voices like Morgan Stanley, leave little room for optimism. The crackdown casts a long shadow, with accusations of stifling innovation and discouraging investment. Yet amidst this turmoil, an intriguing contradiction emerges. Foreign capital is flowing into the Chinese stock market at record levels. This sets the stage for our next chapter. Why, despite the risks and negative sentiment, are global investors still betting on China? So, foreign capital and a government lifeline. So a wave of foreign capital, notably from US investors and hedge funds, is washing over Chinese markets. This buying frenzy reached its fastest pace in 5 years, with nearly 12 billion flowing into Chinese equity funds in a single week, a figure highlighted by both Goldman Sachs and Bank of America. But is this a fleeting trend, or does it signal a shift towards more bullish long-term bets on China? The Chinese government isn't standing idle. To counteract the market decline, the People's Bank of China recently cut benchmark interest rates by 0.25 percentage points. Furthermore, bank reserves requirement ratios, the RRR, were lowered by half percentage points, unlocking funds for lending. There's also mounting evidence of massive state-backed purchases of Chinese stocks, adding another layer of support. Yet the effectiveness of these interventions is uncertain. While offering a much-needed lifeline, they raise questions about long-term sustainability and potential unintended economic consequences. The policy challenge lies in reviving market confidence without creating further distortions. The situation is dire for Chinese hedge funds battling significant losses in this volatile climate. Interestingly, despite the inflow of foreign investment, Goldman Sachs notes that overall positioning in Chinese equities remains at 5-year lows across both hedge funds and mutual funds. This indicates a persistent undercurrent of caution within certain investment circles. Despite these government actions, analysts warn that they may not be enough to fundamentally lift the ailing Chinese market. While lowering rates is intended to stimulate borrowing and investment, the property sales haven't meaningfully rebounded as hoped. This suggests a deeper structural issue that requires more than just tweaking a monetary policy. So furthermore, concerns over the heavily indebted property sector prevail. Many developers, as zombie companies, quote-unquote, kept afloat only by the government support, but with limited long-term viability. The risk is that even with the government intervention, fundamental problems in this crucial sector could continue to drag down the broader Chinese economy and stock market. So now let's talk about a flicker of economic hope. So the last numbers from China's National Bureau of Statistics offer a glimmer of optimism amidst the ongoing uncertainty. While the manufacturing sector remains in a state of slight contraction, the services and construction industries are showing signs of modest growth. Non-manufacturing PMI, encompassing services and construction, rose to 50.7. This indicates a cautious expansion, a welcome signal after months of stagnation. But before we break out the champagne, we need to remember a few crucial factors. First, the holiday impact. The Lunar New Year celebrations likely disrupted January's data, so you might need to await further figures to confirm a positive trend. Then, the global outlook. China, as we know, doesn't operate in a vacuum. A slowing global economy could still dampen its own recovery efforts. So these PMI numbers are like a single flickering light bulb in a darkened room. They offer the faintest sign of hope, but whether they signal a full-blown economic turnaround remains to be seen. If we start seeing some more signs that the government is deregulating or overall loosening the grip, so to say, then we could see a bigger jump in market sentiment across the whole indexes. What is important is not to look for the next Tencent or Alibaba. That's not a realistic approach. Look for big companies that have fallen the most, these companies that will rebound most likely with the same strength. We talk about companies like JD.com, H World Group and so on, but remember, this is not financial advice or any kind of recommendation. Do your own research before making any purchase. Okay guys, so that will be all. Thank you for watching and till next time.